Look at AST SpaceMobile today. I mean, currently sitting right at $90.94.
Yeah.
And the question is, are we looking at a stock trapped in a falling trend with, flashing sell signals everywhere? Or is this the ultimate undervalued strong buy right before it literally launches into space?
It really is the defining financial puzzle of the week, I think.
It totally is. Welcome to today's deep dive. We have a laser-focused mission for you today.
We really do.
We are sorting through this massive stack of fresh market data, technical charts, and financial statements from April 16th, 2026.
Right.
Because we want to decode the intense volatility surrounding AST SpaceMobile, ticker ASTS, ahead of a massive, just company-defining catalyst happening this weekend.
But before we jump into those numbers, let's just establish the ground rules really quickly.
Good call.
We're here to synthesize the data, weigh the argument, and spark some critical thinking. This is an analytical deep dive. It is definitely not financial advice.
Exactly. And hey, if you're joining us on YouTube today, hit that like button, subscribe to the channel, and it is absolutely compulsory that you leave us a comment with your feedback.
Yeah, let us know.
Tell us, are you bullish or bearish on this setup? We want to hear it.
So, jumping in, before we try to predict where the stock is going, I think you really have to understand the massive financial paradox this company is currently sitting in.
Yeah, paradox is definitely the right word for it. I mean, if you look at the raw price action, it has just been a wild ride.
Oh, totally.
So yesterday, April 16th, it closed at 90.94.
Right.
Up about 4.64% on this massive volume of over 17 million shares.
Which is a huge day.
It is. But then you zoom out, and this stock has been the ultimate 52-week roller coaster. It swung from a low of 20.26 all the way up to a high of almost $130.
Yeah, 129.89, which gives it a market cap of around $25.4 billion right now.
Wow.
And this is where that paradox begins, right?
Yeah.
Because you place a $25 billion valuation next to their actual revenue generation.
Yeah.
And you immediately see why the analyst community is so fractured.
Right. So let's dig into that, because their fiscal year 2025 financial statements are fascinating.
They really are.
On the income statement, their annual revenue absolutely exploded. I mean, it grew by 1,505% year over year.
Yeah, massive jump.
To $70.92 million. And on paper, a 1,500% jump sounds like this incredible hypergrowth.
Sure.
But then you scroll down, Q4 earnings per share missed expectations at negative 26 cents. And that resulted in a net income of negative $341.94 million.
Yeah, it's a huge loss.
Yeah.
And if you look at the balance sheet and cash flow,
Right.
cash from operations is sitting at a negative $71.52 million.
Ouch.
So they are burning cash.
Okay, let's unpack this, because the price to sales ratio here is 313.7, a P to S of almost 314. It feels like investors are paying for the penthouse view before the foundation of the building is even poured. I mean, how do we make sense of that?
Okay, your penthouse analogy is actually spot on.
Really?
Yeah, but you have to understand what kind of building they were trying to construct here. This isn't a traditional valuation.
Okay.
That 313 ratio is a pure growth phase premium.
Gotcha.
You see this massive negative cash flow and the unprofitability. It is entirely expected when a company requires the heavy capital expenditure, the CapEx needed to build out this kind of infrastructure.
Because they're not just like writing software.
Exactly. They are building a 240-plus satellite constellation. Launching stuff into space is not cheap.
No, definitely not.
So the market isn't pricing in what they earn today. They're pricing in the monopoly they might have tomorrow.
So moving from the raw financials, the actual business side, over to the moment-by-moment psychology of the market.
The charts.
Right, the charts. If the fundamentals are this huge tug-of-war, what are the charts telling us right now?
Well, it's a very mixed bag.
Let's talk about trend direction and moving averages first, because we actually have a bullish alignment across most time frames.
Oh, yeah.
The 5-day moving average is at 94.07, which is a buy signal. The 50-day moving average is at 91.43, so that's neutral to buy.
And don't forget the 200-day moving average.
Right, sitting way down at 71.26, providing really strong support.
Yeah, so the baseline is strong.
But then you look at the momentum indicators. The RSI over 14 days is sitting exactly in the middle at 52.6 to 54.
Completely neutral.
Totally neutral. But the daily MACD shows negative 0.736. That's a bearish crossover.
Yep.
It's a very clear short-term sell signal.
It is. And then you have resistance looming above us at $97, which is a trend line break, and the recent high of 101.89.
Right.
while downside support is sitting at that intraday low of 86.50 and then the consolidation base at $80.
So what does this all mean for the retail trader watching the ticker?
That's the real question.
I mean, the moving averages are screaming buy, but the MACD is flashing a sell signal. Isn't this just a chaotic, directionless mess right now?
It looks that way on the surface. But if we connect this to the bigger picture, it's not chaos, it's anticipation.
Anticipation. Okay.
Yeah. I mean, think about it. That neutral RSI and those conflicting signals perfectly reflect the current market sentiment index.
The fear and greed index.
Exactly. Right now, it shows a perfectly neutral fear and greed score of 50.
Wow, right down the middle.
Right down the middle. The market is literally holding its breath in this wait-and-see consolidation phase. No one wants to commit right before the catalyst.
Okay, so since the charts are just waiting around for this catalyst, let's pivot to who is actually moving real money behind the scenes right now.
Following the money is always smart.
Because there has been some aggressive selling lately. A major institutional shareholder just sold about $154.5 million worth of stock on April 16th.
That's a huge block of shares.
Massive. And we've also seen insider moves. There was net selling observed in March, specifically from the chief technology officer, Huiwen Yao,
Right.
cashing out about $3.56 million worth of shares.
Yep, the CTO selling.
Here's where it gets really interesting, though. If I'm a retail trader, right,
Okay.
and I see the CTO and major shareholders dumping millions in stock just days before a massive launch, that feels like a blaring siren to me.
Oh, absolutely. It triggers a lot of panic.
Like, are they abandoning ship? Do they know something we don't?
I get why people think that, but this is exactly why retail traders often get trapped. You're misinterpreting the signal
Really? How so?
because you have to look at the countermetric. Yes, they're selling, but despite all that, insider ownership remains remarkably high at 27.7%.
Over a quarter of the company.
Exactly.
Yeah.
Maintaining 27.7% insider ownership still heavily aligns leadership with the company's long-term survival.
So the selling is just, what, taking profits?
It's routine de-risking. I mean, executives get paid in stock, they have huge tax bills when options vest. Selling a few $1,000,000 when you still hold tens of millions is not a lack of faith.
That's a fair point.
It does increase short-term downside risk and volatility, sure, because it's supply hitting the market. But it's not a sign the tech is broken.
Okay, so that brings all these data points together for what I think is the ultimate debate right now.
The big one.
Is ASTS an undervalued first mover, or is it an overvalued trap?
Well, if you ask the analysts, the consensus rating is a very cautious hold or reduce.
Yeah, but those price targets are all over the place.
They are completely wild,
Like, Scotiabank has this low target of 45.60.
which is brutal.
Right, but then Deutsche Bank is way up at $117. The average is sitting somewhere between 77.9 and 86.40.
Which just shows nobody really agrees on the model here.
So let me play the bull side for a second, because I get the hype.
Let's hear it.
The imminent BlueBird 7 launch is the ultimate catalyst for their commercial operations, right?
Yep, happening this weekend.
And if they nail this launch, they are the first movers in satellite-to-phone broadband. I mean, they grew revenue 1,500% in a year already.
True.
And their long-term goal is $1 billion in revenue by 2027. If they hit that $1 billion mark, $90 a share is a steal, right? It's massively undervalued.
Okay, I hear you. But this raises an important question about execution versus theory.
Okay, hit me with the bear case.
I'm going to step in for the bears here. Yeah. Fair value, based on current models, not hopes and dreams, for 2027, is closer to 71.51.
So 90 is definitely a premium.
A huge premium.
Yeah.
And there are chronic execution risks. We've seen multiple launch delays leading up to this April date.
Yeah, that's true. It has been pushed back.
And every delay means massive cash burn for this constellation. But the real kicker,
What?
the competition. Being a first mover doesn't matter if you run out of cash, especially when a behemoth like Amazon is entering the chat.
Oh, man, Amazon.
Exactly. Amazon's partnership with Globalstar is creating massive market headwinds. They have infinite money.
Yeah.
ASTS does not.
So if Amazon decides to just bleed them out by outspending them.
It's a huge risk.
Wow. Okay, so cleanly summarizing the timeline here. Short term, we are looking at extreme volatility tied directly to this April 19 launch.
100%.
A success likely triggers a huge run to retest $100 or more.
Right. and a failure, or honestly, even just a delay.
It sends it plummeting back to that $71 to $80 support range.
Without a doubt.
And long term.
Long term is entirely dependent on surviving that CapEx burn and fending off Amazon.
Which is no small feat. Well, remember, everyone, this deep dive is a tool for your own research, not financial advice.
Yep, do your own due diligence.
But we want to leave you with a final provocative thought to really mull over.
Okay.
So let's say AST SpaceMobile proves the technology works perfectly this weekend. The launch is flawless.
Best case scenario.
Right. But if you prove the tech, but Amazon already owns the infrastructure game, does being first to space actually mean being first to profit?
Ooh, that is a $25 billion question right there.
It really is. Think about that one. We'll see you next time.